Okay, hello everyone. Thank you for your patience. You can hear me okay? We were just sorting out some technical difficulties. So today we're going to talk a little bit about trading some spot gold. And the reason why I say considerations for intraday traders is because I'm going to show you a little bit about what I do, but I need to, of course, build some framework around it, build some context around some basic understanding of price behavior before I get into some details on gold in particular. So that's what we're going to talk about today. Just a little bit about myself. I've been trading FX 20 years now, and I trade S&P and gold as well, and sometimes some oil and stocks sometimes, but not very often. 10 years as a CTA, member of the NFA. Paperwork didn't interest me. So, and then of course I started scaling down my trading the last number of years. So I've kind of gotten away from that. So I've managed funds for private portfolios, mainly through Singapore. In my previous life, I competed in 4 Olympic Winter Games, and we were World Cup champions. So just a bit about my history. Just to give you a little bit of a sense about the framework that I use to trade is I'm a price action based trader. I use a lot of concepts that involve price behavior in relation to liquidity, and volume and volatility in relation to liquidity and price behavior. So we look a lot at microstructure, macrostructure, and we use a lot of fractal geometry. Okay, so let's just get onto some charts now. First of all, the first thing I'm going to do is I want to just talk a little bit about getting a basic understanding of price behavior. So I'm just going to have these charts running here in the background, but I want to first just talk a little bit about how price moves. It's going to be fairly basic in the sense that, many of you may not know the level of detail that we get into, or may not have any use for the level of detail that we get into, but you may find you do so after today's discussion. So let's just look at, for example, if you look at a price, this is obviously like late market hours, but if you look at a price move like this, where you've got a base, okay, and then price runs out like this, and this is a fairly inefficient space right in here. Let's just talk about what goes on kind of in here and the transition from here to the breakout in terms of what it means for volume. I just got a technical thing I'm going to sort out here. Okay, so let's look at what went on here and the transition into this move right here. So if you've got your price feed and price is tracking, and you've got volume coming in on both sides of the market, price is tracking, you've got, like, let's say you've got a fair amount of volume coming in on either side of the market. Let me get my other pen, it's easier to draw. You got volume coming in on either side of the market. And what happens is of course, you get a little bit of a volume surge on one side against a weak spot on the other. So if you've got some sparsity in volume and an increase in volume, obviously the algorithms will then start to shift. And as the algorithms shift, once we break through this price range that we've been in, when it breaks through, it moves into a new state of liquidity. So as you've got volume running on both sides of the market, you have an existing state of liquidity that's present within proximity to current market price, as well as distal to current market price. So you've got maybe a fair amount of volume in here, then it gets thinner and thinner and thinner. And then this is constantly shifting in terms of the depth of your market liquidity. So once price breaks through that level, it moves into a new state of liquidity. And when it gets into a new state of liquidity, what the algorithms do, so if you've got bids coming into the market, what the algorithms will do is they will change how they feed prices into the market. And when they do that, then price will tend to what you'll typically identify is you'll see multi-tick price moves as it's breaking out and flooding into this area. And given that the move, for example, if you were to take a candlestick measurement inside this range for a time period versus a candlestick measurement outside of that range, obviously it's moving a much greater distance. It's filling much more volume as it moves out. Now, within this move, okay, inside this move, you'll find that there is various levels of volume distribution inside this move. So price will go up and down, up and down, up and down. And we're going to talk about this in a little bit more detail in a few moments, but price will jump up and it will jump back, jump up and jump back. And we'll explain why in a few moments. So the important thing to understand here is that when price, so there's a couple of different scenarios here. So if you've got thicker liquidity, you're going to have a little bit of a softer release from this level. But if you're in a more rich and market environment, if you're in a thinner market environment, let me just clean this up a bit. If you are in a thinner market environment, you're going to see a significant release. So on a relative level, the same amount of volume is going to cause price to move further. So that's obvious. Now, there's a difference between the two, and it's important to understand and to get a feel for the difference between the two, because it's going to affect trading decisions that you make once you really come to understand it. So preferable is a thin market environment, a release, but an establishment of a buildup of liquidity that price is based on right here. So let me just bring this over to what's happening actually on a chart here right now. So just to show you these examples. So here, this is a gold chart, and this is later market hours. So the market is a bit thin right now. So this is so you got a consolidation here. Basically within this entire framework, you've got a liquidity base here, and then this is what we call a breakout tag. So it's a buildup outside of the existing range, and when price goes into this very low liquidity state, you'll notice that anytime you've got kind of doji-like candles, very small bodies, you'll find that we are in a low liquidity state. So when we're in a low liquidity state, we are more subject to a significant move out. And when it moves out like this, if you've got a decent framework, you're probably going to see a fairly sustainable move. So this move, this longer term move is based on this framework, and the shorter term move, okay, is based on this framework. So now, when price breaks out, it goes into a new liquidity state, and so once price breaks into liquidity, what it does is it actually draws in a lot more liquidity beneath price. And what price is doing is the way the algorithms work is they spread price just slightly because they have to account for the volatility, because the banks don't want to get clipped. But price is going to run toward the next area where liquidity has been pooling. So price is now in a search for liquidity. So as it rises, it's basically being sucked up like a vacuum. So the thinner it moves out and the thinner the market environment in here, the more it's going to draw up towards that liquidity before it starts to get absorbed, which is what happened here. All right. So this is just a very basic understanding of some rudimentary price movements. This is just a 1 minute chart. So the same concept applies regardless of time frame based on fractal geometry, but we're just going to look at some of the smaller time frames for today. So the next thing I want to just draw your attention to, let me just flip over maybe here to go from let's just pop up a 5 minute chart, 10 minute. So you'll notice that when price starts to go into this, what we refer to as a low liquidity state, you'll find that volume is very low. So when we move into a low liquidity state, we are highly subject to volume surges. So now you can see the framework here is larger. This is very similar to what I just showed you on a 1-minute chart. And just as a side note, I'm showing you this now on a 10-minute chart. So it's the same pattern, but a different time frame. So that's called fractal geometry. Same price characteristics, different time frame. So here's your breakout tag. And so when we're in a low liquidity state, we are most highly subject to breakout scenario, because when price is in a low liquidity state, you can see it's validated here by the volume, obviously. So here volume increases. As you can see, you had the increase in volume and this move down. Price stabilized into a low liquidity state. When price goes into a low liquidity state, what happens is this, is on both sides of the market, as price continues on in this liquidity base, in this stable range, as price continues to move forward, liquidity within proximity of price is actually drawing away from the market. So what it's doing is it's creating more sparsity of liquidity within proximity. So in other words, the depth of liquidity is becoming more sparse at each independent liquidity provider, be it multi-dealer, single dealer, individual banks, investment banks. It's becoming more sparse. So when that happens, of course, it sets up for a more significant breakout scenario. So in reference to what I just spoke of earlier, the volume surrounding that area is getting thinner and thinner. So therefore, all it takes is one volume surge from one side of the market. And here you can see, in this case, we're at the lowest point of liquidity right here prior to the move. And that's right up in here, because here's where the liquidity was being fed from on the top side. So while you have sparse liquidity, it's going to be thicker on this side and thinner on this side. So price breaks out. And the reason why I'm explaining this now is because I'm going to show you how I do short-term trading. And it's important to understand this in context, okay? Because if I just start talking about trades that I make and I give you ABC 1, 2, 3, then you're not going to understand some of the inner workings behind what guided those decisions. It's very important. And trying to cram it all in here in 40, 45 minutes. So once price breaks out, we're going to see a different nature of liquidity. Now, you see this move right here? Inside of this move, price is leaving a trail of pockets of liquidity. All right. So price is going to move down and up, pick up liquidity, down and up, pick up liquidity, down, up, pick up liquidity. Meanwhile, the further it extends, the more it's getting into a weaker market environment. So that is setting up for trade scenario where you're trading weakness into power. So if you've got liquidity down here, you're trading into that weakness. The same applies if you're trading a retest scenario, which we're going to talk about in a bit. But I just want you to understand the concepts here. Okay, so the next thing I wanted to discuss is, I'm going to discuss two more things before we get to some of the techniques, call it. If this is your market environment, if these are pools of liquidity, so what we do is we typically will identify pools of liquidity, and we're looking for price responses at the various pools of liquidity. So if these are areas where liquidity is pooling, price will move from one liquidity pool to the next, and the next, and back, and the next, and back, and to the next, and back, right? Price moves, and then it forms price swings and patterns. So you can see this on the larger time frames as well as the smaller time frames. And if you're trading intraday, it's very important to understand to be able to identify these small pockets of liquidity, because as price moves, it's picking up liquidity. So if we're looking at an individual price move back down here to say let's just go to a 1 minute chart and look at some of what's happened here. So let's just, if you've got a price move on, and it doesn't matter the time frame, but let's just say it's a 1 or 2 minute time frame. Price will rise, form a pocket of liquidity. It will move into a new liquidity state as it continues to rally, comes back down, maybe accumulates for a while, picks up liquidity here, has a slightly larger framework, comes down and touches. So the larger framework overrides the smaller framework. So price may just come down, feed into here, but the level where you're really looking for the price response is the larger framework. So price will release, come back, now feed into some liquidity, then continue. Now let's add volume to the equation so we can understand conceptually what happens with volume. So here, for example, a point I want to note concerning trading gold is you have these very unique and very distinct and definitive periods of increased volume, significant volume surges, 0-100 hours GMT, 0-545, 0-800 hours GMT, 1330 in and around 1330 and in around 1430, which is futures and equities opens in the US. Now, I'll talk about that a little bit more in a few moments, but let's just, so for example, you see right here how price surged when price was rising. Okay, of course, increased volume, increased price rise. Now, if you're to read between the lines, once price releases into a new environment, it's going to have to move further to pick up volume, but it's also sucking up the volume coming in from this side. Let's call it, actually, let's do that in reverse so you're not confused. So you've got an accumulation of inventories here. Volume is getting sucked up as it rises. Volume is getting sucked up. So anybody putting in buy orders here, the price is spreading slightly. You may have a new price right here, but your fill might be up here, of course. If you're chasing price, you don't ever want to do that. And I think you all know that, but you do it anyway, but to try not to do it. All right. So it's actually increasing the volume by drawing up the volume, creating a surge. So this eventually is going to run dry. So there's two things. Number one, it will rise, it will get weaker and weaker and weaker, and it will stop and return. And or as price is rising, you're looking to the left and you're looking to see if there's a presence of liquidity. So, and if there is, you're going to see that price will get sucked up by that liquidity, and then it will retrace or rebalance back into the core base of liquidity down here. And then now, when price, you see the difference in the price behavior between here and here. Price is just bleeding lower. And you can see that it's fairly simple. Increase volume as price rises, and you can see the declining volume as price falls. So this is fairly obvious. The declining volume simply means that as price rises, it's sucked up a lot of liquidity, so it leaves a vacuum in its trail. And so as price is falling, you have a decline in liquidity because all it did is it's drawing back. Remember, don't forget what I just said 10 minutes ago. Price is moving from one point of liquidity to the next. So it's got to come back to pick up some liquidity. And we want to, there's a lot of little quirky little things. We want to see how sensitive it is to, for example, this clean breaking point. We want to see how sensitive the market is to that liquidity. And if it's quite sensitive, which is shown me here, it typically means that the deeper it gets into this liquidity, the more it's going to respond, as you see here. So, which in fact it does. But price is drawing back on low volume, which means that there is not necessarily a lot of sellers coming into the market. Those already got absorbed up here. Not a lot of sellers coming into the market because it's not reflected in the volume. Price is just drawing back, looking for liquidity. It picks it up, and then bam, the move starts again. Okay, so very important little price feature as well. Now, and we're going to show you how this integrates into the real trading environment. And again, the reason why I mentioned these volume surges, and if you're trading gold, you have to know when these volume surges take place. And, you know, I realize I can be talking to a large audience here where everybody's going to look at the market differently. Everybody trades on it on a different time frame. They have different approaches, and they're all making their decisions in different ways. So, so you need to take the information, and if you want to test it and adapt it to your trading, you're all going to do it slightly differently. So we have to understand that. Okay, so there's another quirky feature that I think is important to point out. So, for example, if we are in a high volume period, so here we're at, let's say this is the 1330 kind of framework. This is the 1330 price surge right in here. So, for example, you see you just got a little simple level of resistance right here, and maybe this level of resistance comes from back here where you've got pooling liquidity. So if we anticipate resistance here, one thing we want to do is we want to watch to see if we're looking to trade this surge, because there's a few things that you want to look for the surge. Number one is before the surge happens, you want to look for a breakout to the one side that doesn't work, comes back up, trades against the liquidity pocket, and then starts to move. And you can see here, once it starts to move, it hits the high. So it actually runs into a little bit of liquidity, comes back, it's got to pick up some more. And as it comes back, there's a little bit of a drawback in volume here, which means that this pullback is representative of low volume pullback, which means it's likely to continue. So if it pushes against this resistance and it doesn't put up much of a fight, then the next breakthrough and the next pullback on that move is one where you want to enter, because you've probably got a pretty strong move, assuming you're still in the time at the time of day here between 1430 and 1530. You've got the volume surge. And so, sorry, I can't remember, 1330, 1430 to 1530. So I may not have given the full spectrum there. So you've got 1330 price surge, 1430, and then it can carry on in waves into 1530. I'm getting my metrics mixed up. Okay, so that's where you want to try to look for a surge. So you can see it plays out here. I didn't find today's all that tradable. I was a bit distracted, so I wasn't on top of it, but you can see the surge, and you can see now as volume declines, we repatriated back to the breakout tag where it found liquidity, and then it responded. So this is actually, yeah. Okay. So this is actually from yesterday, I think. Now, so basically what I'm doing here is, let's go over to, let's kind of start from the beginning and pull some of this together. So this is a hourly chart. And let's go all the way back to the daily here. What's interesting here is that, so this is kind of what we're going to do now is we're just going to kind of break it down a little bit, go from the top down, and then talk about what it means for the moment. and bring some things into context. So here we've got a bit of a base right here. And the one thing that's really disturbed me about this entire up move and price coming down and retesting is that we still have left this tiny little gap. And I'm thinking this can still get filled up into this area right here. So if you refer to what we talked about earlier, you've got a area there, a larger area and a little smaller area than the breakout. So we could potentially come back to this area and respond. But in the meantime, you're going to respond to some of these smaller levels. So the next level I'm really looking at is around that 1825 level. I think we can come down here and fill. Now, if we start to see some reversal type scenario play out here, you want to be trading these price surges in the direction of typically of hourly momentum. So you want a few days of hourly momentum in one direction, at least maybe a day or 2 days of hourly momentum. So when that shifts, you want to be trading in the direction of the momentum if it builds a base here. If it breaks out lower, then you want to be trading to the short side. Okay, so just to get a general sense for where momentum is heading, good idea to have a look at your higher time frames. Now, taking it down to the 1 hour chart, you can see we're pretty sideways, and here's our base. That price didn't quite get down to that low, but the way I would see this is that we're kind of trapped. It's what we refer to as a trapped fractal, in the sense that you're between this area of liquidity and the support at the lows. So it's trapped. It's just kind of topping out at the moment. And if it breaks to one side, you're probably going to see a nice little run up towards the highs as it looks for liquidity. If it breaks to the downside, then you're going to refer to your levels on the higher time frame. So that's how I'd be looking at this, trading inside this range. If we do turn at the top of this base right here and turn back inside, then maybe there's trades inside this range, but it may not give you quite the power that you're looking for. There may be more volatility that you've got to contend with. So that is something that needs to be considered. Taking it down to the 15-minute chart, here's what it looks like. If you're looking at this, we've come back up and we've fed back into liquidity. We tried breaking out lower. And if we do break above this 1865 area, again, if you have a look at this, you've got your breakout tag. Here's your larger framework, which we showed you earlier. So this one here is going to be significant. But if we break through here, you should see a run to here. So to here, and then back, and then up. Okay, there's a lot more detail we want you to look at in here. I don't have time to get into it, but that's basically what we'd be looking at. So I'd be looking to trade to the long side. So now let's take it down to, call it an intraday scenario, where let's say, for example, with what happened here. Let's talk about what happened through the course of today. This is a 10-minute chart. So you'll see that price had a strong surge. I want to show you the time of day features here. Today wasn't ideal, but still pretty consistent. So this is exactly, you see how this down move right here is exactly 1330. Okay, exactly at 1330. You had a big volume surge, pushed through, went into a new state of liquidity, and it exhausted itself. Usually what they do is another side little, I always throw in these side quirky little points. You see right here, this is what's called, a little a liquidity void price run extension. So we extended into the new liquidity state, but look how quickly it sucked back up, and it stopped right at this point right here. So that's usually the first point. Once it comes back in, if it comes back in, then you're usually looking at it drawing back into the range. And that's what happens here. So there's your the 1330 surge. And if you look further over here, you see this highest volume area right here. This is your 1430, your 1430. So here's your 1330 and your 1430 volume surge. Okay. Now, when price was coming back here, volume dropped right off, which suggests a base is being built, and all it's doing is it's filling in a void of liquidity and more likely to surge than not, right? Okay, stay with me. Price builds, goes into a low liquidity state briefly here, makes a run up. See right here? In fact, Bitcoin did this around, just for those of you who are Bitcoiners, it did almost exactly this down around 11,000. I said to our members, Bitcoin's probably going to rally and probably get to around 16,000. And it did. So it did form this little similar type pattern. This is why we call it fractal, because I'm showing you on a 10-minute chart, but Bitcoin was a daily chart. So you see how it does this? Now, it's getting a little bit late in the session, but we still see the same pattern play out. Price rises, and as it rises, you've got higher volumes. And as price retraces during this move, if you take it down to the 1-minute chart, so here's what you do, is on a 10-minute chart, price is rising. Then what you're going to see, if you take this and you magnify it and you move it to a 1-minute chart, you're going to see 10 candles, right? On the down candles, so here you're going to have an increase in volume. On the down candles, if the volume is lower, all we're doing is retracing back into that void of liquidity, and liquidity is sitting down here waiting. And then you're going to see here an increase in liquidity, and you'll see volume because liquidity is sitting down here. So once it hits that liquidity, there's an increase in transaction, increase in buyers, and then of course, price is going to adjust accordingly. This was just bleeding price. So there's not a lot of deposits in here. There's not a lot of selling inventories being built up here. So this move can be fairly clean and very surge-like. So now I don't want you to forget that in the very first section of the discussion today, I was talking about some very rudimentary aspects of price behavior, and people might just blow past it saying, I already know that, I already seen that, that's simple, whatever. But now you can see how it gets more niche-like as you are applying it to overall market structure. So it's great that you can say, okay, I understand some of these rudimentary elements of price, but how do I apply it? Where do I apply it? When do I apply it? So this is basically how I'm applying it on the gold charts, more specifically around, for example, what I would like to have seen here during the 1330 volume surge is I would have liked to see it work through this area, break out here, okay? And as price comes back, see declining volume and pick it up right here. If volume is increasing, that means it hits liquidity here and you're actually maybe heading down. So you don't want to be trading against increasing volume. You want to see it start to decline. So if volume starts to decline, you want to pick it up, looking for a surge to the next level of liquidity, because as price is bid down at these levels, and once it creates that market movement defined as I discussed earlier, then you are going to see that these price relationships and microstructure really play out quite beautifully. And the more you work at it, the more it becomes self-validating. Any one of my members who will tell you that, you know, they weren't entirely clear on how everything was pieced together when they first started, once we get them into the charts through a properly structured format, and once they see the price behaviors in relation to volatility and microstructure and price relationships come together and feed into one another, then it becomes self-validating. And then you start peeling indicators off your charts. So this is the type of scenario. That's in fact what I was looking for today. So there's another thing that I would like to point out right now is that, and this is a subject matter on psychology. So let's take it down now to maybe the 5-minute chart here. So let's say, for example, we got here 1530. So there's your 1530 volume surge. So right here, you can see on this volume surge, we would have hit, I want to make a couple more points. There would have been liquidity available up here, transfers over here. So you see how you get a volume surge here. When the volume surges, price is getting weaker, weaker, weaker. Another volume surge, price gets weaker. When it, on a rising volume surge with a weak base, when it hits liquidity, what happens is you'll actually see a little bit of an increase in volume here because you have resting orders and inventories here. So that's got to be transacted. So it absorbs price. So then it basically defines a new trading range. As price tries to get through, it gets weaker and weaker and weaker on declining volume. And then price starts to break lower. And then once it breaks lower, sometimes you see volume increase. Where is it going? It's looking for liquidity. And you can see this is an area right here. And then you've got an area here. You can see it there. And then this breaks down into this levels. So you got your clean breaking point, your core structure, your point of release, your base structure. And then you've got where it's standing, and then where it's standing here, and where it's standing within the context of the overall structure. So there's little liquidity pockets all the way through here. And you can see just how price responded. Now, so let's say, for example, you were to want to look for a trade at, say, for example, this level right here. And this is extremely important because it gets back into a basic lesson on fundamental psychology, in that as much as I could show you an ABC 1, 2, 3, here's how you trade, look for these 4 things and then make the trade, it doesn't really work that way, because you've got 1, 2, 3, 4 items. Maybe these are some of the core elements that you are looking at to trade. You need to understand each of these core elements in such depth that it becomes, it is so deeply ingrained in your trading persona that it will never leave you, because every one of you has a unique mental and emotional framework. So you have to take the rudimentary elements and dynamics of price behavior, and you need to marry these behaviors to the uniqueness of how you see the market. So in order to do so, just to understand one of the dimensions, you've got to get in there and you've got to work at that one dimension from many different angles. And each one of these, the same. So you need to understand each of the 4 dimensions to such depth that when you get to entering a trade, so for example, if I just give you an ABC 1, 2, 3, and you go and you follow 4-step rule, copy me trade type system, then you're going to be trading mostly blind, 90% blind, 80% blind. And you want to reduce it from being 80% blind to being only 20% blind, because you never have full vision of what the market's going to do. In order to do that, because what happens is that when you comes time that you want to make this trade, is you will enter the trade based on some copy me rules based system. Then the market will start to take on certain behaviors, and they can be behaviors that you may not recognize, you may not be comfortable with. And the fact that you're having difficulty identifying what's actually happening in the market is going to affect how you think about your trade and the money that's at stake and the risk that's on the trade, because the market is now taking your brain to a place that it's never gone before. So just like in anything else that you've ever done or ever succeeded at, you need to take your brain to somewhere that it's never gone before. And in order to do that, you need to create a process of understanding each of the dimensions discussed herein. So for example, if we take it back to the start of the discussion where I talked about some rudimentary elements of, a price move, more buyers and sellers, of course, price moves up. We all understand that. I can talk to 100 people and one person will say, oh, it's supply demand. And then that tells me pretty much how much they understand about trading. I can talk to somebody else and they can get into the finest level of detail of what has taken place and what has unfolded in that market environment, because they have engaged in so many experiences, and the way that they've engaged in the experiences is such that it actually starts to become a part of their logical processes, and it becomes internalized understanding of microstructure, and then they'll be able to apply it. So when you apply it, as price is moving around and just doing its thing while liquidity works itself out, the one who is highly competent in this area is going to have a better grasp on their risk management and trade management. So in order to do that, you have to take the concept and you have to put it into practice, and you have to do countless sample sizes and countless exercises so that you can really understand that pattern. And not only that, if somebody gives you a copy me 1, 2, 3 system, your goal is not to trade it the way they trade it. Your goal is to understand the concepts and then create it in the unique way that you see the market, because you will identify things that other people will not, but it is based on the same principles of understanding how price works. Okay. So these are gaps that I see in individual traders that need to be filled. And so while I can show you something fairly, a fairly basic framework here, it works, but you're not going to be able to do it tomorrow. And don't try to do it tomorrow because it would be foolish. Take the concepts, go out, put them into practice, but break it down, and really break it down in a way that you really understand that behavior. So I've given you a few things here to work with, and I think that it can maybe help you get off to a good start, because not everybody here is a price action volatility trader. Some of you use mathematical models, indicators, who knows what, and there's nothing wrong with that. If it works, it works. Many of you have gone through this type of process, many of you have not. So I just want to give you an understanding of something about trading that you can't avoid. All right. And so hopefully maybe some of this answers some of your questions, but what I'll do now is I'm going to flip it over to YouTube so I can see your questions and try to get through some of your questions. So do you does anybody have any questions? Happy to go over it. I try to be as straightforward with you as I can. We have if you go to protradersclub.com, we have a free members area, and there's some information in there you can go through. A lot of people seem to find it helpful. It's fairly basic stuff, but I give you some ideas on how to build your trading career and some understanding about some decent understanding of market structure. So, Steffi, the question is, how can I understand the market structure of where price will go next? Of course, it's never definitive, but price moves from one point of liquidity to the next. And there's many ways that you can practice that. So for example, you can see here just on this chart that we have right here, you can see that, so here you've got some basic market structure. So you can see here inside this market structure, you have little more micro structures. You've got these little periods there where price stalls and builds some framework. And then here you've got a volume surge, and then that's when price leaves. In fact, that volume surge is 1330 hours. You can see right down here, 1330. But we build this framework, but price is moving from one point of liquidity to the next. So when it breaks out, there is highly likely a pocket of liquidity over here. Price goes out, comes back, picks up liquidity, but watch this. Okay, watch this now. I want to show you what happened here. So, I might just say, look what happened here. Price moved from this point to this point, but it gets more finite than that. And let me just point out a couple of things. You see how price came down right here, and then it got bid up, little volume surge, okay, because price had broken out to the upside, little bit of a volume surge. You see where this one here, this candle opened up, it's a point of release, price goes right back up there, picks up liquidity, okay? And then price continues to move lower. You see this clean breaking point, there's usually liquidity build up there. Now, if price hits that clean breaking point and it responds sharply, then you're probably going to see that hold for a while. Right here is a point of release of that move. So there's a little volume buildup right in there. This is really important information, okay? Little volume buildup right up here. Look what happens. Price goes up, hits liquidity, comes back, picks up liquidity, bam. Volume surge, picking up the liquidity, bam, price moves out, and there you go. So then, now watch. Price goes from a larger framework, swings out, swings back, hits the larger framework. Now watch what happens. Watch this now, okay? Price comes down. The bodies. You see this move right here to here? This is where it released from, okay? Right here. Why did it release from there? Let's go. You see this consolidation right here. If you take this down to a smaller time frame, you got a breakout tag right here. The volume surge occurred right there. And then bam, it moves out. So there's still inventories. Price comes down, picks it up, releases to the upside. Okay. Really, really, you see how finite this can get? And can you see how well you can marry your unique brain to that of market behavior? This is really, really, gets more into the nitty gritty. So then where is it going to go next? So you're looking for these little pockets of liquidity. So once price is breaking out and it's pretty strong, okay, and it breaks out here pretty strong, as I pointed out, when price breaks out, it's probably going to the next area of liquidity, which you'd see on a higher time frame represented over here. Okay, it's not as simple as support and resistance. It gets much deeper than that, but that's a response to your question. Okay. There's, because some of you are asking, there's a free members area here at protradersclub.com. As well, we have, it's not posted anywhere on the website yet, but we do have Black Friday offers. And this is the link. If you email me, I can send you the link. We do have Black Friday offers, but you can go here to the free members area, check out what's in there. If you connect with the material, great. Maybe it'll help you. It should. I receive very, very little, almost no negative feedback. And that's also because we filter people before they come into Pro Traders Club by the nature of making sure that they are very clear in their decisions. So, Gandharv, how are you? Nice to see you guys. And I saw a few of you others here that are Pro Traders Club members. Yeah, Morton, how you doing? Good seeing you guys. Which time frame do you recommend looking for low liquidity states? So that's a very good question. So that gets into fractal geometry. Now, I look for low liquidity states. If I'm trading long term, then I'm looking for low liquidity states on a daily chart, and that's where I'm, looking for reference points to make trades. Because, of course, I trade gold long term as well. Gold has very beautiful structure to it in trading at both long term and short term. Very, very beautiful structure. So I'm looking for it on all time frames. That's fractal nature. So I'm looking for the same price behaviors playing out on a long time frame as I do as a short time frame. It looks the same on a chart, which is fractal geometry. Looks the same, different time frame. It's basically fractal geometry is just scalability. That's why when you understand these types of concepts, your trading is very scalable. So I'm using the same concepts, whether I'm trading a short-term charts or trading long-term charts. Of course, there's little idiosyncrasies in there, but it's all basically the same technical framework. Okay. When you see pockets of liquidity on top of each other, how can you tell which one will be stronger for price to come back to, then take up liquidity again? So usually the larger overrides the smaller, and not necessarily all of them are useful, right? So you want to pick over time, you establish which ones are most useful and which ones are most likely to draw liquidity towards, to draw a price towards that level of liquidity. And so if you're making your trading decisions off 5-minute charts, it will be different from somebody who's making trading decisions off a 15-minute chart. But usually the size variability is a contributing factor as well. You have to consider what is the underlying influence of market flows is very important also to have a sense for. So for example, you don't want to be making trades or entering trades before 1330 hours, because you could just get surged out. Or when the market sweeps the book, you might just get whiplashed out. You're better off to wait to see how price is going to play out. And there's another surge coming at 1430. And so 1330 often sets up 1430. Okay. So it gets into, it obviously gets into a little bit more detail. Okay. What are the top 2 indicators that you would recommend? Thank you for attending. To be honest with you, I don't use any indicators at all. I don't use any indicators. And what traders find is that the more you adapt price behavior and the more it becomes self-validating, then the more you peel away these secondary type tools. And I'm not saying that trading with indicators is wrong at all, because if it works for you, it works for you. Some people trade when the cow jumps over the moon. So I'm not one who's going to say no to any way of trading if it works for you. If that's how your brain thinks and you've connected your brain with a niche in the market, then there's no one can deny it if you've validated it. So the times mentioned, those are in GMT time frame. So remember, depending on where you live, when daylight savings time kicks in, that can shift, but it'll be easy to pick up in the first few days of trading. In reference to other, call it mentors in the market, yes, there's been a large number of individuals who are currently mentors in the market that have gone through my program, at least 12 that I can name offhand, that I have the records of their, access to my materials. How do you measure liquidity? Is it by the horizontal range of time? So GJ, yeah, so I'm always using horizontal reference points. But if you're looking at, let's say if we take this down again to say a 10-minute chart, if you're looking at, for example, if you look at this framework right here compared to this framework right here or this framework, they all have So they all have consistent characteristics, but they're all unique, right? So one will have more power than another. And I actually like this one up here because there's different price features. So there's different, these actually have somewhat similar price features. You see how this one here, rose on declining volume. So here, you know, you had these little surges, they didn't last. So, and we're actually seeing this on the higher time frame as well. So if you look at what's happening right here on this smaller time frame, it's also happening on the daily chart. Same type of pattern right now. But so they get defined by, there's a number of other characteristics in terms of what price looked like when it rose and how it broke down to determine whether that next breakout lower is going to be traded, because we look for reversal and weakness in these movements. So the market actually gives you a lot more information than you realize. Once you get deeper into its study, the market brings a lot of information forward. And so that's why like one will differ from the other. So this one seems to be building a base, and it does look like it wants to break out to the upside. If it does, I want to be trading this to the long side in future sessions. So 0-100 hours, you're probably going to see a surge and maybe even a breakout surge to right around this point right here, 1868. So if this breaks out at the 0-100 hours time period, it could suck back in, but if it breaks out, probably going right around 1868 is probably where it's going. Okay. What do you think about following the trend in trading? Yeah, so it depends on how you trade and what you define as the trend, because if you're saying trend, it could be, is it the trend on the daily chart, the 17-minute chart, the 2.5-minute chart, the tick, the 26-minute chart to chart. But you do want to be able to identify the underlying flows based on what the market is telling you. So when you're trading in gold, then you want to be trading with the near-term momentum. So the last 24 to 48 hours, you want to try to be trading with that momentum. If it's not moving or if it's consolidating, trade the momentum back into the range. It's a little bit higher risk. It's a little choppier, but you can still trade it back into the range. The volume indicators, it depends. We did studies on volume indicators, and we also did studies even in foreign exchange, where the volume is maybe measured by the flows to a specific entity, and they are typically within 80%, which is reasonable enough in terms of overall volume structure. And so they're reasonably consistent is what I'm saying, regardless of your provider. Within that 20% band, they're reasonably consistent. So there's a question here about the higher time frame. So as I mentioned right now, I need to see, right now we are looking like it may reverse here. So if it reverses, we could see a shot to the upside. So I don't want to be jumping on top of anything until we show distinct reversal scenario, which I've just showed you. Otherwise, if we move to the low side here and I start seeing, let's say, for example, if I were to zoom in on this area right here, if I were to see if this is your breakout level, if I start to see price breakout, I want to check out the state of liquidity on the breakout, and I want to see how price is retesting that level and what price is doing when it feeds into liquidity. Then I want to be selling short. Okay. And I want to be selling it down into this area. Okay. So thank you all very much for your time. I apologize we were late. We had a little technical issue, and I just want to thank you all for coming out. You can come see us at Pro Traders Club. And just join the free members area. check it out. Don't make any decisions unless you've had a chance to walk through the content a little bit in the free area. And don't forget, we've got some Black Friday deals on right now. You're probably going to receive the most content value for money than anywhere. Okay, so thank you very much. We appreciate you all. As far as live workshops go, I see a question here. We don't know when they're going to let us loose. Okay. I'd love to do another live workshop. It'd be great. I enjoy the people. And when you sit all by yourself in an office all day long for 20 years, you need to be around people and other traders. So it's a pleasure. It's a pleasure to share. So thank you. Thank you all very much. I appreciate that you've been respectful. And that's very important to me, and it keeps me coming back. And so thank you all very much.